Hi everybody, welcome to the Shock Factor series, video number 15. And in this video, we shall be looking obviously at the 15th hurdle in trying to apply technical analysis to the markets or in the markets. Again, this is Shock Factor video 15. Okay, let's press on with the rest of the slides. Again, in this video, well, it's a particularly interesting video because we will be discussing the scenario when trading suddenly becomes like driving with the brakes on. Now, what do I mean by this? Well, everything will be revealed within the next few slides. But again, this tends to happen in the market quite a lot, especially with rookie traders or beginners who do not really understand the mechanics of the forex market. Now this, let me be very clear, this video specifically applies only to forex pairs, okay, only to the forex markets. It doesn't apply to any other market. It doesn't apply to the equity markets. It doesn't apply to the bond markets. It doesn't apply to any other markets except forex, the currency markets, okay? It is a peculiarity specifically with respect to the forex markets, okay? So let us press on with the rest of the slides and let me explain why trading sometimes becomes like driving with the brakes on. Pressing on to the next slide. Let's assume that we have opened 9 fully automated FX positions in the market. Assume that these are the 9 pairs that we have just opened in the market. Let us just make one more assumption that all these pairs will open simultaneously at the same time, just for the sake of simplicity, okay? Not at different times and all that. All right? So let's assume that 9 pairs will open in the market, fully automated forex positions. Okay, and these are the lot sizes. Some are long, buy, some are short, sell, and so on. So some are long positions, some are short positions. And let's assume that, let's work in mini lots. Let's just keep things simple. Let's just work with mini lots. And let's assume for the pound yen, for example, we enter a long position with 1 mini lot. And say if the dollar franc, we enter a short position, or we sell to open a new position. We sold 0.65 mini lots, for example, okay, or 0.65 mini lot, and so on. And you open all 9 positions in the forex market using full automation. And now these are all open positions, okay? Assume they are all open positions in the market as we speak. Okay, let's just assume that, okay? All right. Everything else being equal. Okay, now the $64 million question is this: will you make money? Will you make money? Is there a chance that you make a profit? Or maybe you might suffer a loss. But the question is, do you think you'll be profitable with this setup? Let me press on to the next few slides and let me explain why you will not be profitable. In fact, it's impossible to be profitable if you have these 9 open FX positions with the associated lot sizes and directionality, long and short. If you have this set open in the forex market, you will not be profitable. And let me explain why. This is the perfect definition of driving with the brakes on. But why is that? Why having a setup like this in this configuration is akin to driving with the brakes on? That means you won't make any money, okay? You won't be profitable. Let me show you why. A lot of traders won't understand why this is the case, but I'm going to show you mathematically why this is not a profitable setup. This is a directionless setup. It is pointless. Let me show you why. Let's press on to the next slide. Okay, let's assume that this is a snapshot. I took a snapshot of the market quotes. This is a snapshot just a few days ago. And let's do an experiment, okay? So this is the bid and ask prices for all the various forex pairs, okay? Again, let's do a little experiment. Let's just focus on the pound, or the cable, and the yen, okay? Let's just focus on these two. Okay, again, in short form, I'll call this pound US dollar, I'll call it GU, US yen, or dollar yen, I'll call it UJ. UJ. GU. Okay, I'll use the short form. Okay, so it's easy. We don't have to spell the whole thing out each and every time that we refer to it. Okay, all right, let's press on. Let's do a little experiment just for the fun of it. What if we multiply these two together? What do you think we'll get? Do you know the answer to this? Let's just multiply this exchange rate by this exchange rate. The GU is the UJ. Of course, you'll get GJ. Let's see whether this is true. If you multiply these two together, the product of this and this, you get 198.57. If you look at GJ here, or pound yen, yes, it's 198.57. So we learned something. There is some kind of underlying mathematical relationship here that's going on. Something is going on here. And what is it? Quite simply, it's basic triangulation. We call it triangulation. Pound, you can actually write it in this way. Pound dollar, dollar yen, denominator, numerator, cancel each other out, we get pound yen. You see that? It is a mathematical relationship. So this exists as a tri-pair. Tri-pair means three pairs. As a family, as a tri-pair family, they are interconnected mathematically. It is a strictly mathematical relationship. Any movement in GU and any movement in UJ will obviously affect the exchange rate for the GJ. Obviously. Conversely, any movement in the GJ will also affect these other two. These other two forex pairs, GU and UJ. They are all interconnected. There is a very strict mathematical relationship. So this is the first thing I want you to understand. We call it triangulation. This is proof. You can see, look at the market quotes on your left-hand side of the screen. You can see, multiply this by this, you get this. There we are. Right to the second decimal place. Okay, now I want to develop on this. Mathematical. I want to talk more about this. Let us push on to the next slide to develop this understanding of this particular mathematical relationship. I want to elaborate a little bit more with respect to this mathematical relationship and what this means when you start trading in the real world. Okay, let's press on to the next slide. Sorry, there's one more thing I just want to add before I forget. So this also means that if you're going to be trading, for example, you want to go long on the pound, on the pound dollar, and you also want to go long on the dollar yen, it's exactly the same as just going long on the pound yen. That's all. You don't have to go long here and long over there. Just go long on the pound yen. That's assuming if you want to go long on the pound on the pound dollar or the dollar yen. Might as well just go long on the pound. It's the same thing. It's identical. If you want to go short here and short over here, you might as well just go short over here. Just trade one currency. It's the same thing. Essentially, fundamentally, it's the same. But there's a caveat. On the charts, when you look at the charts itself, if you're going to go long here and long here, long on the GU and UJ, although I said it's mathematically is identical to just going long on the GJ, but when you trade the charts visually, optically, it's not the same. I'm going to explain that in a short while because this chart is much more volatile than these two. And these two are the GU and UJ. The cross pairs are always highly volatile by way of the multiplication factor. That's right. Let me explain this in the next slide. Okay, for example, again, as I said, this is rule number one. We must understand this. There is a mathematical relationship between GU, UJ, and GJ. As explained here already, this is why. Okay, this is why. It's called basic triangulation. So, okay, we now that we understand this and we have proof, this is proof here. Okay, I'm not just stating random facts. This is proof, mathematically proven. Let's assume right now that let's assume that there is a 1% increase in the parent pairs. Okay, let me go back. This is the parent pair. I call this the base parent pair. I call this the back parent FX pair. And this is the cross pair. Okay, so let me say it again. This is my definition, just to make things clear as far as this YouTube video is concerned. Because I will not go into extreme detail, but enough for you to understand. It's sufficiently enough for you to understand. So these are called anything ending with the US dollar, okay, as the counter currency, that's the base pair. Okay, anything with the US dollar as the base currency, the front currency, the base currency, I call it the back parent pair. Okay, and any forex pair without the US dollar involved, it is referred to as the cross pair. And this is one tri-pair family. Okay, they are all mathematically connected, related, interrelated. So let's press on to the next slide. So in this case now, since we understand rule number one, there's a mathematical connection. Okay, this is a tri-pair family. They all belong to one family. Let's assume that we are looking for a 1% increase in the base and back parent. That means in the parent pairs, we're looking for, let's assume there's a 1% increase in the parent pairs. 1% increase in GU, and as well, there was a 1% increase in UJ. How many percent did the cross pair increase by? That's the question. So the answer is quite simple. There is a mathematical relationship. There is a multiplication factor involved. So if this increases by 1% and the UJ also by 1%, you have to multiply 1% by 1% to get the answer here. So of course, we cannot multiply percentages. We only can multiply ratios. So let's convert 1% into its ratio form. So therefore, 1% can be written as 1.01 in ratio form. You want this to increase by 1%, this exchange rate, just multiplied by 1.01. We can't use the percentage. Mathematically, we have to use the ratio form. So 1.01 represents 1%. Similarly here, so because it's a multiplication factor involved, we multiply this by this, we get 1.02. That represents, approximately 2% increase, okay, in GJ, in the cross pair. So the parent pairs, let's assume that both the parent pairs increase by 1%, the cross pair will increase, or GJ will increase by 2%. If you multiply this by this, you get 2%. Now you understand why cross pairs, that means forex pairs that do not involve the US dollar, they are very much more volatile. Why? Because they are a product. They are the product of the parent pairs. A 1% increase in either one here, only a 1% increase, you get a 2% increase in the cross pair. That's why GJ, any currency that represents a cross pair, that means the dollar involved, the dollar is not involved. Okay, it is just pound yen. There's no dollar involved. They are much more volatile. Much more volatile. Okay, maybe with the exception of the euro pound. The euro pound is not that volatile, although it's a cross pair, but you know what? The pip value is very high. So that makes up for the lack of volatility as comparatively speaking to other cross pairs. Okay, I just want to mention that. But if it's a cross pair, it is still going to be, in dollar terms, in dollar value, very volatile. And this is why, because there is a multiplication effect involved. There's all cross pairs, on average, they are very much more volatile. That's right. Okay, let's carry on. So since there's a multiplication factor, 1% increase in the parent pairs will result in a 2%, roughly 2% increase in the cross pair. Okay. Now, in terms of the number of pips for that 1% up move in both the parent pairs, and again, a 2% move to the upside in the cross pair, how many pips were involved for a 1% move? Well, the answer is quite simple. A 1% move to the upside will result in 134.34 pips in the base pair, base FX pair. For the back pair, a 1% move to the upside will involve 147.8 pips. And similarly, for the cross pair, it be 2%, twice the amount. So whatever 1% is for this, multiply that by 2, you get 397.14 pips. So a 1% move either to the upside or to the downside. For every 1% move, it involves, for these exchange rates currently that we are looking at, it will involve a 134 pip move on average. For UJ, it will involve 1% move either to the upside or downside. It will involve about 147.8 pips. And for the cross pair, a 2% move to the upside or downside, it doesn't matter, will involve roughly 397.14 pips. Okay, so this is a pip per 1% move. Per 1% move. Either to the upside or downside, it doesn't really matter. So for every 1% move, this is number of pips that will be involved in both the parent pairs and the cross pair, based on this current exchange rate. Okay, now let's press on to the next slide. So far, I'm sure everything is very simple. It's not complicated, okay? It's very straightforward. Anyone can understand this. Let's go forward. Press on to the next slide right now. So again, this is the same thing as from the previous slide. I just want to point out something, that the pips do not tally up. For a 1% move in either direction, for the GU, that equates to 134 pips. For the UJ, it's around 147 pips, and for the GJ, it's around 397. If you add these two, the parent pairs together, you only get 282.14 pips. It does not tally up with the cross pair. That's okay. That's okay. But what we want is for it to tally up. There's a reason why I'm saying that. You may not understand why. It will become crystal clear in the next few slides. But just to bring to your attention, just for you to understand right now, in this slide, just understand that they do not tally up. And they will never tally up. Under most situations, they will never. The total number of pips for the parent pair will always be less than the cross pair. I just want you to realize that. Now, how are we going to move forward from here? What we want is for it to tally up. But it does not tally up. So what do we do? But why do we want it to tally up? Why? What's the reason? I'll explain in a short while. Let's press on to the next slide. So again, the pip increase, this is 134, this is 107, this is 397, it doesn't tally up. If you add these two together, it doesn't tally up. So never mind, let's turn our attention to the dollar value. For 134.34 pip move, how much in dollar value is it worth? How much is it worth per 1% move? Well, quite simply, for GU, because this is a standard pair where the US dollar is the counter currency and the pound is the base currency. Whenever you have this situation in the Forex market, the pip value is always fixed. It's always $1 per pip for a mini lot. For every 1 pip move, it's worth $1 US. It's always fixed. It doesn't matter whether it's GU, whatever it is, there's a base currency. As long as the US dollar is the counter currency, for every mini lot, it's always worth $1 per pip. For every 1 pip move, it's $1. For those who are trading Forex, you understand this. Okay, I do not want to go through the mathematics to prove this. Of course I can, but a YouTube video is not a place to do that. There's too much information. Okay, what about this? How about the UJ? Since the US dollar is the base currency, the number of pip move is 147.8 pips multiplied by the pip value. So if you just use this formula, you will get the pip value. Okay, and also for the GJ, the cross pair, the pip value is identical to the UJ. So the cross pair, whatever Forex pair ending with yen, whether it's GJ, UJ, whatever, EJ, like Euro yen, whatever, it doesn't matter. It will all be, they will all have the same pip value. Same pip value. That means the same value in dollar terms per every 1 pip move. Okay, so multiply by that, and what you get is this. So for 134 pip move, based on $1 per pip, the total value of that move, for 134.34 pip move in the market, that is worth $134.34 US. For the UJ, okay, the back parent pair, you multiply by this, you get $100. The funny thing about this is that it doesn't matter whether it's UJ, whatever, it is US or whatever the back currency is, or the counter currency, whatever the other currency is, whether it's J or whatever it is, Canadian or whatever, it doesn't matter. This value will always, for all back pairs, whether it's UJ or otherwise, it will always be $100, always. Because this and this will always cancel out. This and this will, the numerator and the denominator will always be the same. Just a few decimal places difference. And for every mini lot, for every one mini lot, the base currency is worth 10,000. 10,000 US dollars. So that's why we use 10,000. If it's a standard pair, this will be 100,000. If it's a micro lot, there'll be 1,000. It depends on what kind of lot sizes you're working with. Here, in this case, in this video, we are working with mini lots. So it's 10,000 divided by this amount, and you get 100. For 147 pip move for every, and this represents a 1% move. Okay, this basically is worth $100, and this will always be the case for the back parent pair. For the base parent pair, it will change, but for the back, it will always be 100. Doesn't matter what currency this is, as long as the US dollar is the base currency, it will always be 100 mathematically. This will never change. That is the interesting part of this. That is why I highlighted it in yellow. Now for this, of course, again, with same pip value, okay, as the back parent pair, this will come to $268. Again, they do not tally up. When you add the dollar values for the parent pairs, they do not tally up with the cross pair. Okay, similarly to the previous slide, where the pips do not tally up as well. The total pips for the parent pairs do not tally up with the cross pair. This is one family, but they do not tally up. And when you come to the dollar value, the same thing as well. The dollar values do not tally up as well for a 1% move. Let's press on to the next slide to elaborate just a little bit more. Now, before I go on to show you how to tally up, there is a rule that we have to assume. Rule number 2. We have to assume for us to tally up this situation, the base parent and the back parent, they always have to be directionally consistent. They have to be directionally aligned. That means if GU is long, UJ must be long as well. And there's another condition. The cross pair must be directionally opposed. That means non-aligned in the other direction. So if both parents are long, the cross pair must be short. If both parents are short, the cross pair must be long. You understand why in a short while. But let's assume that this is rule number 2. Okay, let's go on to the next slide. So remember the dollar value, 134, 100. If you add these two, these two do not tally up. I've already talked about it in the previous slide. For every 1% move, okay, they do not tally up. For every 1% move, either to the upside or downside, is worth $234.34 US dollars. For the cross pair, for every 1% move to the upside or downside, is worth $268.7 US dollars. Okay, so they do not tally up. What does this actually mean? Okay, let's assume a situation where both the parent pairs are long, according to rule 2, and the cross pair is short. Now, because let's assume the market moves to the upside, it moves up. So for every 1 pip move to the upside, the parent pairs in total, they make $234.34 US dollars per every 1% move to the upside. So that's great, fantastic. It's making a profit. It's generating a gain. It's extracting profitability from the market. But what about on the other side? Because don't forget, we have open positions in all 3. They are all open positions in the market. So although this is making $234.34 US dollars per every 1% move to the upside, this is losing $268.7 US dollars per every 1% move to the upside. So overall, if you open all 3 positions, this will be making money. Let's say this makes $234 US dollars to the upside. Let's assume we have a 1% move, but this has lost 268. So overall, if you open all 3 positions, you'll be losing money. This only makes 234, but the cross pair loses 268. So you're losing money. So if the pairs are long, there's a net loss as you move up 1%, 2%, 3%. The parent pair is not able to cover the losses generated by the cross pair. So you have a net loss to the upside. But what if the market moves to the downside? Then this will be losing because now the market is moving to the downside. The parent pairs will be losing 234.34 users per every 1% move to the downside. But look at the cross pair. This is making 268.7 US dollars for every one move to the downside. And this is making money because it's short. But the parent pairs are long. But this is short. So overall, if the market moves to the downside, assuming the parent pairs are both long and the cross pair is short, you'll be making money. This will be losing a certain amount, but this will be making more. So overall, there's a net gain. Net gain. Now, assuming the second scenario, if both the parent pairs are short and the cross pair are long, this could be the opposite. Okay? Because both parents are short, as it moves to the downside, both parents will be making, in totality, the both parent pairs in totality will be making around 234 US dollars per every 1 pip move to the downside because it's short and the market is moving to the downside. So it's making money. But the cross pair is long. So this will be losing 268 US dollars per 1% move to the downside. So overall, it's losing money. There's a net loss. This is making 234, but this is losing at the rate of 268 per every 1% move to the downside. So it's losing money. So therefore, if the parents are short, these two, UJ and GJ are short, there's a net gain to the upside, but there's a net loss to the downside. Let's just assume that we are going to apply rule number 2. And this is going to be the conditions by which we are going to be trading. Okay, let's just assume that. Of course, there are other combinations. We've seen all this already. Okay, this is just I'm just repeating what has been stated on an earlier slide. We know all this. The dollar value, they do not tally up per every 1% move. We know that. The question is, how do we make it tally up? What is the solution? How do we do it? How? Well, this is the answer. It is quite complex to go through the mathematics. I'm going to spare you all that. I'm just going to go straight to the solution. For a YouTube video, it is not the place to go into extreme detail. Okay, I do not want my YouTube videos to be too lengthy, but in this video, I do give you the solution. Again, we know this. This is rule number 1. There's a mathematical relationship. To make all this tally up, the dollar value, the important thing is the dollar value, this one, here. We want this to tally up. So for every 1% move in either direction, this amount will be equal to this amount. So therefore, we have a situation where the entire tripair, they are what we refer to as in a state of being fully hedged. So as you move 1% in either direction, whatever you make or lose will match whatever you make or lose on this side. So we are in a fully hedged position. But how do we do that? Okay, there's one way we can do it very quickly. So again, this is a mathematical rule. We understand this. This will never change. Sometimes it might be slightly dislocated. Slightly. Okay, this might run a little bit because of the inefficiency of the markets. The market is not totally efficient, not 100%. But again, normally this will be returned back to its basic relationship, its basic underlying mathematical structure by way of arbitrage. Because if there's a dislocation, okay, or discrepancy between or within this mathematical relationship, the arbitrages will be right in there very quickly to bring it back to normality. Okay, bring it to the baseline itself. The arbitrages, they actually serve a very important role in the markets as well. Yeah, okay. It serves to keep the mathematical rule here for this kind of tripairs in check. They try to keep it in check by way of the mechanisms that they use for arbitraging this kind of situations when there's a discrepancy, okay, or a dislocation of this mathematical relationship. Okay, let's press on. So how do we tally up everything, especially the dollar? How do we do it? Simple. This is I cannot explain why this is the case mathematically because it's too complicated, but just trust me, this is the answer. Just adopt the base pair exchange rate as the lot size for the back pair. That's all. If you do that, presto, you are fully hedged. So in this case, we have this exchange rate GU, UJ, GJ. Here we've seen this before. And we've seen the dollar value, 134. This is always going to be 100. The back pair will always be 100. Doesn't matter what currency it is. It will always be 100. And GJ is 268.7. To tally all this up, just take the exchange rate of the base pair, adopt the base pair exchange rate as the lot size for the back pair. So the mini lot that you have to trade, this will be 1 mini lot. This, as you know, is a 1 mini lot, but this will not be 1 mini lot anymore. This will be 1.34 mini lots, identical to the exchange rate of the base parent pair. And if you do that, this will be 134.35. We'll round out. Instead of 47, you just round it up to 35. Okay, so 34, you just round this 4 up to 5. Just round it up. You always round up. And we get this amount. So it's 134.35 plus 134.35. 100 times this, you get 134. Add these two, you get exactly 200. Now, finally, they tally up. And what was the mechanism that did that? By adopting the base parent pair exchange rate as the lot size for the back pair. That's all. I can't prove to you mathematically in this video, but just trust me. This is the shortcut. Okay, this is the shortcut. Let me just make my final statement. I call this the freeze ratio, lot sizing. So therefore, if you have 1 mini lot for the base currency, for the back parent currency, you have 1.34. You have adopted the exchange rate as a lot size for the back currency, back parent pair, and your cross pair is again 1 mini lot, as we started off in the beginning. But this is the only one that has been modified to 1.34. If you have this ratio 1.341, you are at what I call the freeze ratio with respect to lot sizing. That means you are fully hedged. For a 1% move here, either to the upside or downside, will equal a 1% move here to the upside or downside. They are totally hedged, fully hedged. So you will not make any money going if the market moves to the upside, because this will make, this will lose. If you move to the downside, this will lose, this will make, especially if it's long short. Okay, as explained in the earlier slide here. You've seen this already. Okay, so let me just go back. This I call the freeze. So if you have this ratio 1.341, you are at the freeze ratio. That means you will not make money regardless of whether the market moves up or down. Isn't that shocking? This is basic triangulation at its most extreme form. Because what we've done here, for the value, we adjusted it by 1.34. So the lot size, similarly, we adjust that by 1.34. Go over to your trading platform, enter 1 lot GU, 1.34 lots UJ. You assume you go long for this, and you short a GJ by 1 mini lot. If you use this ratio, long short, or short long, either one, you find that your total profit and loss will not move. You will stay static for a very long time. Eventually, it will drift a little bit because of trading costs, slippage, swap, overnight interest, and all that stuff. Okay? Eventually, you start to drift slowly, but it will stay there for the longest time. At least 1 week plus. You won't see, regardless of how violent the market moves up and down, whether the market gaps, even with gapping and market shocks, your profit and loss will stay exactly around break even. It will not move. But eventually it will drift because of the other things involved, trading costs and all that, slowly. And that means you're going to lose money. Not only you can't make money in the beginning, everything is frozen, everything is fully hedged, but over time you lose money. So what I'm trying to say, okay, is that this is a hedge position. So therefore, specifically for this example, for these exchange rates that I'm showing you here, for GU, UJ, and GJ, if you have a ratio of 1.34 and 1, as seen here, 1.34 and 1, because we need this to tally up, okay? As you get closer from above, assume you have 1.45, assuming this is 1 minute mini lot and this is 1 minute lot, but let's assume this is 1.45. As the lot size gets smaller and smaller, as it diminishes and gets closer to 1.34, the more you're going to be fully hedged. So in this area, anything above 1.34, you're partially hedged. Anything from below, as you approach to the upside towards 1.34, although you're partially hedged, but as you hit 1.34, you'll be fully hedged. And that means regardless of whichever way the market moves, you're not going to make any money. And over time, because of trading costs, you're going to lose money. This is critical information that you must know. A lot of people don't understand this. If you hit 1.34 to 1, you're going to be fully hedged. I call it the freeze. Your account is frozen. The positions engaged in the market by this tri-pair, your profit and loss will be totally frozen. You won't be going anywhere. You won't be going anywhere soon. Regardless of what happens in the GU, on the GU chart, regardless of what happens on the UJ chart, whatever it is you're doing, regardless of what happens on the GJ, it makes no difference. If it's 1.34, 1, I call this a freeze ratio, you're in trouble. You are driving with the brakes on. The market is moving all over the place at 100 miles an hour, but your profit and loss is static. It's not moving. So you're putting your pedal to the metal, you're using all the gas that you have, you're revving your engine, you're trying to move forward with your handbrakes and your brakes on at the same time. Nothing is going to happen. And in fact, you're going to damage your vehicle. You're going to damage your car. Over time, you lose money because the repairs involved is going to cost you by putting your vehicle under that kind of stress. Similarly, putting your trading vehicle, your platform, under that kind of stress. You see what I'm saying? There is an analogy there. Serious analogy. Yes. Very serious. So now let's go back to the origin. Now again, this is an example. All the various. Maybe it's not an exhaustive list, but it's good. So these are all the parent pairs, where the US dollar is the counter currency. Here, the US dollars are all the base currency, and these are all the cross pairs. As you can see, XXX USD doesn't matter what's in front, euro, pound, whatever. As long as the counter currency is USD, that will be referred to as the parent pair. The base parent pair, the back parent pair, we have the US dollar in front, okay, as the base currency. And this is the tri-pair. This is tri-pair number 1, tri-pair number 2, tri-pair, and so on. So whenever you trade any of these 3 currencies, any of this one family at any one time, you have to be extremely careful that you do not hit the freeze ratio for that particular currency. Okay, now that you know how to calculate what that is, and you don't have to calculate, just take the parent pair as the base currency, and that will give you the freeze ratios immediately. No calculations involved. Straight, direct, immediate, optically, visually identifiable instantly. I've given you the shortcut how to do that. So avoid any ratio like this. If you're trading any ratio like this, especially with this configuration, you have to be extremely careful because you could be driving with the brakes on. You could be trading with the brakes on, okay? Let me just move forward, okay? So let's go back to the original 9 pairs when we first started in the beginning of this video. I've color-coded this, so if you go back to the original 9 pairs, this I've separated out. I've color-coded. So notice, this is the base pair, base parent, the back parent, and this is the cross pair. 1.34 is the freeze ratio. I'll show you why in a short while. The second tri-pair is this. US dollar multiplied by USD, you get Euro Canadian by the mathematical relationship. And this is the third one. Okay? Aussie dollar multiplied by US dollar franc, you get Aussie franc. Notice something. All the back pairs have a different lot size. This is the back parent pair. Okay? This is a back parent pair. US is in front. And US is in front here as well. This, and this. All forex pairs that you see here in front of you, where represents the back parent pair. They all have different lot sizes. I've purposely done this because these are the freeze ratios, the perfect freeze ratio. So if you trade these 9 currencies based on this mini lot sizes, your profit and loss will be frozen. You won't go anywhere. And over time, you lose money because of the trading cost. Okay, let me show you. Let me rearrange it. So this is what I refer as a total freeze ratio. If you have this setup and you're running this fully automated markets, regardless over the next 1 or 2 weeks, regardless of where the market moves, you won't make any money. But you lose a little bit with respect to the trading costs. You do not want to be here. This is a bad place to be. Let me explain that. Rearranging everything, as you can see, 1.34 for the yen, US yen, 1.34 in loss. This lot size comes from here, the parent pair. So let's look at the pound USD, 1.34. So that's where we got 1.34 over here. What about this, 0.65? We look to the Aussie dollar, to the exchange rate. Aussie dollar is 0.65. 0.6. So that's why, and that's where this comes from. So we short, the crossbear has to be long. Short, crossbear has to be long. Long, crossbear has to be short. Similarly for this. Okay? All right? So this, what's the freeze ratio for this? 1.1.341. So this is what you must avoid. This is what you must avoid. Now, again, there are multiples. Instead of 1.341, you can, if you multiply everything by 2, that would be 2.682. This also represents the freeze ratio. You must not have this kind of settings as far as your lot size is concerned, because it's identical to this. This is exactly the total fully hedged freeze ratio as well. You have to be very careful. Even if you have any other multiples, for example, just randomly multiply by 3.8, everything multiplied by 3, you cannot have this kind of lot sizes. If you have 3.8 in the parent pair, the back pair you have 5.09, and the cross pair 3, but you are totally frozen. Your profit and loss is frozen, static. You're not going to get anywhere. You're driving full blast. The market is moving aggressively, but your profit and loss is not going anywhere. Not going anywhere soon anyway. You're driving, you're trading with the brakes full on. You see that? You're sabotaging yourself. And for this, again, going back to this, this and this, for this and this, it's the same. The freeze ratio for this is 1.6, or 0.65, and 1. This is the freeze ratio. You can multiply by any number of multiples you want, as long as you avoid this, and this. This is the baseline, but whatever else. You can multiply by half as well. Divide all this by half. 0.5, 0.3 something, and then 0. It doesn't matter. These are all the total fully hedged positions with respect to a lot that you must avoid, because otherwise you're not going anywhere. So going back to this slide, I just want to say one more thing. You see, this represents the degree of hedging. As you get closer to 1.34 from below or from above, as your lot size gets smaller, going towards 1.34, the more you are going to be fully hedged. The more you'll be trading with your brakes on. Here, your brakes are full on. You're not going anywhere in terms of your profit and loss. Here, you see a bit directional. Here, you are still directional. You still make or lose money because you're not fully hedged. You're not totally, your profit loss is not totally frozen. So here, you are directional. But as you get closer to 1.34, you get less directional. You get more frozen. Similarly, from the upside, lot size falling, diminishing towards 1.34. So there are various degrees of driving with the brakes on. But in any case, it's a bad thing. Why would you want to drive with the brakes on? So you must avoid this ratio, especially for this example, and again for all this here. These are the ratios you must avoid, plus including its multiples. You have to. Otherwise, the closer you get to driving with the brakes on or trading with the brakes on, and that doesn't make sense. Why would you want to slow down your own trading? You want to be fully directional when you make money. You see that? Unless there's a special reason why you want to do that. For example, I'll give you one useful way of using this. For example, you're trading with 2.5, 1. So okay, you're still driving with the brakes on, but not full on. You're still directional, so you're making money. But then the weekend comes. The weekend comes. And you decide that you do not want to exit any of these positions. For some reason, I don't know what that is, but for some reason, you do not want to exit. So when it comes to the weekend, what you can do is that you adjust the lot size to 1.34. So over the weekend, whether there's a massive gap, a market shock, it makes no difference. Your profit and loss is not going to go anywhere anyway. And then after that, you can readjust this back to wherever you want it to be. That's one use of it. But it's not an easy thing to do. It's quite complicated to orchestrate something like that. I don't recommend it. But I'm just saying, hypothetically speaking, you can do that. Yes, of course. You can use this as a hedging tool. That means you don't have a stop loss. You don't need a stop loss. This itself is its own fully hedged setup without a stop loss. Okay? Stop losses will not save you over a weekend gap. Because if you have a weekend gap, the market can gap beyond your stop loss and you still can lose money. Because stop losses represent market orders. They guarantee to exit you, but there's no guarantee that you exit at the price that you want. But in this case, it's different. You don't need a stop loss, but you're fully hedged. So whether it's a market gap or whatever, it will not affect you at all. Because this is mathematical. You have a mathematical stop. Can you see? There is some use for this kind of thing, but I don't recommend using it that way. But I'm just saying that there are many ways that you can use this knowledge. Okay? All right? So having said that, that brings us to the end of this video. Again, I thank you for joining me in this video, the 15th short video. I hope you gained something from this, some enlightenment, and please avoid the freeze ratio if you ever get close to it. Just if you recognize it, get away from it, because it's not going to do you any good whatsoever. So that's why I'm saying, going back to the first statement, if you have something like this, you make no money whatsoever. Doesn't matter how much market movement there is. It doesn't really matter. You're not going to make anything. You'll be frozen. Be trading with the brakes on. That's what I mean. Okay. Thank you so much for joining me in this video. Again, I shall see you in the next video very shortly. But until then, as usual, take care, be safe, and bye-bye.